There is a gap on the Bitcoin chart right now that smart money is going to come back and fill, and most traders cannot even see it. It is called a fair value gap. Once I show you how to spot one, you will start finding them on every single chart. In the next few minutes, I am going to show you exactly what a fair value gap is, why it forms, how to find a real one on Bitcoin, and how to actually trade it. No magic indicators, no fluff. Let us get into it. So what is a fair value gap? Keep it simple. A fair value gap is a price imbalance left behind when the market moves too fast in one direction. You find it using three candles. Look at the middle candle of a strong move. Then look at the candle right before it and the candle right after it. If the wick of the first candle and the wick of the third candle do not overlap, the empty space between them is the fair value gap. That little untouched zone is where price moved so quickly that buyers and sellers never traded fairly. The market simply skipped over it. Why does this matter? Because the market hates inefficiency. When price rips in one direction and leaves a gap, it means one side completely overwhelmed the other. There was no balance. Big institutions know there are resting orders sitting in that empty zone that never got filled, and price has a habit of coming back to that gap to trade through it properly before continuing. Traders call this filling the gap or rebalancing. The chart goes back, fills the imbalance, and then very often carries on in the original direction. That return is your opportunity because you already know where price wants to go. Now, how do you identify a real one? Because not every gap is worth trading. You need three things. First, displacement. The move that creates the gap has to be strong and aggressive. A big candle with real force behind it, not a slow drift. Second, a clean three-candle pattern where the first wick and the third wick genuinely do not overlap. That untouched space is the gap itself. Third, the gap should sit inside a move that breaks structure, a fresh high or a fresh low. That tells you real momentum created it, not random noise. Displacement, a clean, unfilled gap, and a break of structure. All three, or you skip it. So how do you actually trade it? You do not chase the move. You wait for price to come back into the gap. When it taps that zone, you watch for a reaction, a rejection, a shift in momentum. Your entry is inside the gap, often right around the halfway point, what some traders call the consequent encroachment. Your stop goes just beyond the far edge of the gap, because if price closes clean through it, the imbalance is gone and your idea is dead, so you want out cheap. Your target is the nearest pool of liquidity, the recent high or low where stop orders are stacked. Tight stop, much bigger reward. That is the whole point. Let us look at Bitcoin. Picture a sharp move down. One big red candle slams price lower with force and breaks the low underneath. Now look at the candle before that drop and the candle after it. Their wicks do not overlap, and that empty space in the middle is your bearish fair value gap. A day or two later, price bounces and crawls right back up into that gap. And what happens? It gets rejected inside the gap. The imbalance gets filled, and price rolls over and continues down. If you knew that gap was sitting there, you were not surprised. You were ready and waiting. Here is the mistake almost everyone makes. They mark a fair value gap on every tiny three-candle pattern they see, and then wonder why it does not work. A gap with no displacement behind it is just noise. The power comes from the strong move and the break of structure that created the imbalance. Small gaps inside choppy sideways price get filled instantly and mean nothing. Be picky. The best gaps come from violent, obvious moves. If you are squinting at the chart trying to force one, it is not the one. Quick recap. A fair value gap is a price imbalance left by a fast move, found on three candles where the first and third wicks do not overlap. The market comes back to fill it because it hates inefficiency. You need displacement, a clean, unfilled gap, and a break of structure. You wait for price to return, you enter inside the gap, you stop beyond the far edge, and you target the nearest liquidity. That is fair value gaps, start to finish. If this finally made fair value gaps click, hit subscribe, because next I am breaking down liquidity, the fuel that drives every single one of these moves. Fair value gaps and order blocks work hand in hand. So if you have not seen my order blocks video yet, watch that one next. I trade these concepts with real money on Bitcoin, and I show every trade, win or lose. One last thing, this is educational only, not financial advice. Crypto is risky, so only ever risk what you can afford to lose and make your own calls. See you in the next one.